Okay, I make that 1 minute past 3, so we will not hold on any longer. We'll fire away. Thank you very much for your patience. I know some of you have been online for a good 10 or 15 minutes, so thank you very much for your patience. So that just leads me to say, good morning or good afternoon, depending on where you are in the world. I know we have attendees from different continents, so yes, good morning or good afternoon. And welcome to the latest webinar from Block Asset Management. This webinar is entitled The Role of Digital Assets in an Investment Portfolio. Most of you will know me, but for those of you that don't, my name is Kevin Ballard, and I am co-founder of Block Asset Management, which is a Luxembourg alternative investment fund manager specializing in blockchain and digital assets. In December 2017, we launched the world's first digital assets fund of funds. And therefore, in essence, Block Asset Management are an institutional grade risk filter, identifying and selecting the best in class funds or managers to allocate within our diverse and award-winning fund of fund structure. Today, I'm joined by our Chief Investment Officer, Yanis Georgiandelis, who will be providing his views on the role of digital assets within an investment portfolio. So without further ado, thanks Yanis for joining us. We've taken you out of your CIO cupboard and allowed you to integrate with society in the world. So thank you very, very much. I guess first thing is to say, address the year. So 2022 has been quite a year for investors within all markets. We've had numerous geopolitical events disrupting global economies and markets. We're in the midst of a bear market across all asset classes, including digital assets. And we are seeing rate hikes and inflation rising at rates that we've not seen in decades. So we used to hear that Bitcoin and digital assets were a good hedge against inflation. Is that still the case?
Thanks, Kevin, for this question. You're right to refer to inflation. True that inflation is sky high, reaching uncharted territories, at least for the last decades, way beyond the normal range. And therefore, it sounds a bit like we're back to the 70s, and all of a sudden, we need to actually be extremely careful and protect the value of our assets in real terms. And in this context, you want to avoid inflationary assets. You want to focus on scarcity. You want to actually implement new strategies to preserve the real value of your assets. And Bitcoin in the past and has been referred to as the digital gold, and being a store of value, since the supply of Bitcoin is limited. There is a cap, we all know, at 21 million, to be compared with the unlimited supply for the monetary basis. Then obviously you say, okay, store of value, scarcity. Maybe it's a good strategy to invest in Bitcoin as a hedge against inflation. And many investors actually invest into this thesis on the basis of scarcity. And so we tried to figure out if does it make sense. And actually what we found out is that maybe there is a misconception between value and price. The reason is the main driver of Bitcoin has been the change in liquidity, the money supply, and not so much the evolution of the number of Bitcoin being created. And so we're just saying, yeah, we understand the reference to digital gold, but in reality, in practice, we don't see Bitcoin as a hedge against inflation. It's actually liquidity and an expensive monetary policy, which is likely to support the Bitcoin price. So it's a misconception, and it wouldn't be a good idea to use this rationale to actually preserve your portfolio against the impact of inflation.
Okay. Well, then what do we flip that? So it's not a hedge against inflation as was often referred to. But what about equities? It seems that the early narrative of investing in digital assets as a hedge, whether it be against inflation or equities, that this has fallen away as digital assets appear to be declining in tandem with equities. So we look at the market performance there. they've fallen in tandem this year, and in other circumstances earlier on have risen in tandem. So can you explain or elaborate that?
Yes, you're right, Kevin. If you look at this chart, the dark blue line shows the correlation of Bitcoin versus the S&P 500 total return. As what you can see is that the correlation has not been stable over time, and it's been on the rise recently. If you look at the second line, the dark blue line, September to December 2018, yes, indeed, at that time, in the past, Bitcoin could be a hedge against the equity risk, since we had a slightly negative correlation. But this has changed, and if you look at the recent decline from February to March, the correlation has been increased to 0.588, which is quite significant, and hence our perception that equities and Bitcoin evolve a bit in parallel. And on average, it's 0.258, and this is the orange line. So it shows that there was a huge increase in correlation during the last year and recently, and therefore Bitcoin is probably not a hedge anymore against the equity risk.
Okay, so if I play devil's advocate then and say, well, not a hedge against inflation, not a hedge against equities, why should I invest in digital assets at all?
Yeah, it's a good point. And the reason why actually you want to be invested in digital assets is that we've been too focused on Bitcoin as a diversification outside equities, and maybe we forget to actually see that within your alternative investments, if you need to allocate some of your portfolio into alternative investments, there is a clear decorrelation between precious metals, alternative investments, and Bitcoin. And therefore, it makes sense to add digital assets into your portfolio, but within the alternative investment section. If you look at the orange lines, you look at the correlation of Bitcoin versus gold during periods of decline, or it doesn't matter the market environment, the correlation has remained very low, close to 0.056, close to neutral, and therefore it really makes sense to diversify outside gold. And when we know that the precious metals have, performance has went nowhere during the last decade, diversifying your alternative investments into digital assets would have been a smart decision, even in a portfolio context.
Okay, so when you say digital assets, I guess for a lot of people that are attending or listening, they think digital assets, or we talk digital assets, and Bitcoin springs to mind. So if we're going to invest in digital assets, is it best to just keep things simple and just invest in the largest and most well-known cryptocurrency or digital asset, which of course is Bitcoin? So what do we say to those that say, well, I'll get my exposure just by investing in Bitcoin?
I'm with you, Kevin. We need to keep things simple, except that there are secular trends. And one clear secular trend is the fact that Bitcoin is going to lose market share, and it's normal. The asset class is expanding, and increasingly, Bitcoin's market dominance or market share is going to become thinner and thinner. And you don't want to actually remain invested in an asset which is not going to be sidelined, but is going to be less relevant because there will be other opportunities, and you don't want to miss the opportunity to fully participate in the asset class return. If you wish, presented in another way, a couple of years ago, you wanted exposure. There was one pick, it was Bitcoin, and it was easy, it was simple. Nowadays, if you look at the market capitalization and taking into account all the market verticals, on the right side, you can see a pie chart, and it shows that actually Bitcoin, if you want to have Bitcoin, it shouldn't be more than 40%, because the other parts of the market are with DeFi, NFT, gaming, dApps, and stablecoins, and therefore, if you want to capture the full potential of the asset class, you need to be diversified.
Okay, so I want to pick you up on that. So when you say diversified, I know that people in the audience are thinking, okay, explain more. So I know that obviously this asset class is very diverse. It has multiple verticals, but for those that are listening in, we say diversification. There's more to digital assets than just Bitcoin. We've said that, and I think that's apparent to everybody. How true, I guess the asset class is now a broad ecosystem with different sectors. I'm asking you to really elaborate a little bit on this. So for the audience sake, you've said there's more than just Bitcoin and you need to diversify. Can you just elaborate on this a bit? So what else is there out there in the ecosystem that people need to pay attention to or be aware of?
Sure. The first point is that the asset class has become very complex. There is a full ecosystem of different market verticals, which represent themselves each an opportunity. So we started with cryptocurrencies, Bitcoins, of course, as the flagship investment. And then we had the development of another vertical, which is the smart contract platforms. And we know some names here, Solana, Avalanche, Ethereum, of course, but not only this, DeFi, which was a new vertical, which arose after the 2018 crisis. And you have also in this space new protocols, new opportunities, Uniswaps, Lido, Yearn Finance. And it's very complicated because if you want to decide if you're going to invest in Lido as opposed to Yearn or Uniswap, you need to understand the technology behind. You need to understand why maybe this vertical is likely to outperform or not, maybe some other verticals. And we had the emergence of stablecoins, which is today a pillar of the asset class, but also not to be forgotten, Web3 infrastructure providers and NFTs, the Metaverse, and so on and so forth. So you have thousands of projects, different market verticals that keep expanding, and so hence the opportunity, but also the complexity. For example, the Metaverse. How can you invest in this space? So you could invest in Metaverse coins, like for instance the Sandbox, but you could invest also directly through NFTs or buy a virtual land or even rent it for an income. So you already see that you have different angles when it comes to investing, even in a defined vertical. And we didn't even mention EVC. This sector, I mean, early stage investments, private companies have attracted billions of dollars over the last couple of years. And that's where you can find the biggest success, for example, Solana or Solare, which is a football game like Panini cards. I mean, this is where you can expect the highest long-term return at the expense of liquidity, but it's a must. So you already see that it's not only the different market verticals for the liquid investments, but it's also the opportunity to invest in sectors, private sectors, where the juicy returns are, and you don't want to miss.
Okay, just staying on this a second. So I guess for the audience's sake, if we're looking at private equity and venture capital, what are the typical issues maybe with audience members or anybody that, if they look to invest in one of these sectors, how difficult is it for somebody to get into, and what are the typical problems somebody in the retail sector, for example, might face if they're looking to invest in one of these type of funds? Access.
You don't have access. Those are projects where first of all, you need to source the right deals. You need to have teams on the ground. You need to have IT experts assessing if a technology is going to work, is ahead of maybe competitors. So access is very difficult. You don't have access to those opportunities, the best opportunities, and therefore you need to delegate this, and you need to actually pick up the specialists on the ground and being able to source the right deals. And you know that there will be some failures, but you don't care because they are focusing on 100x investments.
Okay.
Of course,
I'm gonna say, so okay, so from my experience on that, then, you know, we saw in 2017 and 2018, those of us that were investing in digital assets around that time, we saw the boom and sort of bust cycle of ICOs, where I guess a lot of crypto investors had made a lot of money very easily and very early. You know, those that were pre-2017 had found it very easy to make money in digital assets as the market had that huge growth swing in 2017. And I remember having invested in that space myself during that time, that there was a lot of the phrase ICOs, a lot of initial coin offerings where there was white papers left, right, and center offering you to invest in a new startup, a new project. You know, everyone's looking for the next crypto unicorn. So what you're saying is, by investing in these VC funds, they in essence, I know that they in essence have replaced ICO investing. So the ICO marketing to the public has just gone now. It was boom and bust, and a lot of those didn't have any substance to them. And because they didn't have substance, there was a lot of poor investments that died a death. Am I right in saying that these VC funds and PE funds, they've come out really to assist with that, to replace the ICO of raising capital from retail investors that maybe don't know what they're doing and don't know what to look for in a project. And now instead, you would invest in VC and PE style funds that have the research teams and the knowledge to be able to identify, do the relevant checks and find out whether a project does have the potential to be successful and become a future unicorn, correct?
Correct. In a way which is very similar to what is being done for, you know, traditional private equity. It's just that their focus is on blockchain and those and related projects, early stage projects. And we don't even refer to ICOs nowadays. So they're investing in companies with a real underlying business. I mean, companies using the blockchain technology and achieving sales, showing a lot of growth, and also early stage, you know, early stage tokens, and where they can participate into a project growth, but based on the underlying technology and fundamentals. So very similar to traditional PEVC, except that there are a number of there is a bit of everything, except that you can find some funds, some specialized teams having an edge and being able to source the right projects and invest for the long run.
Okay, so I'm guessing that if it, like normal VC and PE funds, there's going to be a very high barrier to entry that would prevent retail investors from getting into such funds, correct?
Correct. You don't have access. You just don't have access, and you don't have the expertise, and you just cannot source deals. And the smartest way to actually participate in this opportunity is to actually select the right fund manager specialized in those sectors, and being able to invest in a number of projects, because you need to diversify. The rate of failure is quite high, but they're going to select the next Sorare or the next Solana, and those are investments which actually from a few $1 million valuation went to a few billions.
Understandable. Just want to drill down that a little bit, because I do find it's an area that I get with clients or potential investors. It's an area they find very interesting, but obviously when they try to look for a VC fund themselves, they're put off straight away when the barriers to entry are so high. And typically $1 million plus to get in, and most investors don't have the availability to get in at that level. So, you know, if you have $1 million, then great. But whether you want to put all of that into a crypto fund is a big ask. So typically people are putting a smaller percentage in, and therefore going into a VC fund is normally, as you say, accessing it's out of reach to most investors. So I just thank you for elaborating on that.
It's also important, sorry, Kevin, it's also important to keep in mind that overall liquidity is a key factor. I mean, you don't want to add a liquidity risk, an additional risk layer to an asset class which is already quite risky, because you have higher expected returns. So overall, you want to participate, but you want to be stuck with investments having a low liquidity.
Okay, we're just staying on that then. And one more question, last one on that section, I promise, is you mentioned there a little bit more illiquid. Of course, everyone will understand the VC fund or PE fund is a bit more liquid. But can you tell me what percentage of portfolio, I'm keeping it on our fund now with Block Asset Management, where would you say is a sweet spot percentage-wise of a portfolio to be in, of a crypto fund of funds to be in this particular sector, so VC and PE? What weighting would you say was ideal?
Okay, it depends on your general preferences in terms of liquidity, expected return, but we at Block Asset Management, we believe that we should have a long-term allocation between 20 and 25, 30% roughly in PEVC strategies, because that's where the best opportunities are, and there is and it's enough to participate without undermining your liquidity profile. You can still have liquidity, a reasonable liquidity overall, keeping that type of diversification in place in this strategy.
Okay, just before I jump on the next question, just a reminder really, I didn't say at the start, if you have some questions, I see one or two have come in, please feel free to just type a question in the questions tab down below, and then we'll get through to one or two of those questions at the end. So next question from myself, Yanis, would be, you've mentioned multiple verticals and different sectors in the asset class, whether that be NFTs, DeFi, Web 3.0, but is it not the case that everything's up or everything's down? You know, well, what's the case for allocating to multiple sectors if they're all up together or all down together?
It's true that on surface, it might be a bit everything the same. It might be the same. I mean, you might see, okay, everything is going up, everything is going down. So does it make sense to diversify? We actually wanted to find out how we stood on with regards to this question, and we took as a proxy for a diversified strategy. We took the Blockchain Strategies Fund, and we tried to see if we are actually fluctuating in line with Bitcoin, or if we were able to actually decorrelate because of the diversified strategy being in place. And historically, what we found out is that the correlation is fluctuating, evolving between 0.5 to 0.8. Of course, it's been on the rise this year, but the decorrelation of a diversified strategy as opposed to a single asset participation strategy, I mean, is high enough to make the case for a diversified strategy, I believe.
Okay. And then with regards to being able to be able to create something that does provide diversification, we've just seen earlier on, you mentioned that there's many verticals in the asset class now. We mentioned that there's, we want to sell the concept of diversification. So when it comes to exposure to digital assets, can you just explain a bit more of how we go about true diversification? How can that be achieved?
Yes. Oh, obviously you have different approaches, but our view is that particularly since the asset class has been expanding, and that now with DeFi you can actually implement fixed income strategies with lending, staking strategies, and there is also the expansion of the PEVC sector. You can implement a diversified approach amongst different types of strategies, fixed income, so typically a type of absolute return strategy, but also PEVC and trading for active management, and of course participation with the beta passive strategy. So we believe that it's a very good start, and then you need to diversify amongst the different sectors, obviously, that you can find within digital assets. So that would be our recommendation: multi-strategy, multi-sector approach.
Okay, so as a CIO, if you're looking at these different sectors here, how and when I mean, weighting controls are obviously in place for each of the sectors. How and when do you rebalance and look at what you have allocated to each of these strategies, and how do you go about addressing that as market changes, or as your weightings become maybe little bit screwed because one particular asset class here, let's say your trading or quant or fundamental strategies have a very positive couple of months, and maybe their performance therefore means that your allocation to that sector is maybe a little bit over where you ideally would be on your. So I guess the question is, how do you come about your ideal weightings into the portfolio, and how do you work to maintain those weightings, or do you maintain those weightings?
Okay. We have defined internal benchmarks with regards to the long-term asset allocation, strategic asset allocation we want to have. But then we implement a tactical asset allocation. For instance, last year we were overweighted PVC strategies. This year,
conscious decision, sorry, Alice, was that a conscious decision to go overweight, or did the performance of those particular strategies take you overweight?
It's a combination of both. So we reflected the evolving market environment, the bear market. So by reducing the overall portfolio's risk profile while maintaining the potential for the participation in case of recovery that we can see not far away. But we reflected essentially the market environment into all different asset allocations, reducing the highest beta sectors, reducing PVC and increasing the fixed income part, and increasing the allocation to active managers, being able to actually implement different types of strategies, quant strategies, discretionary strategies in a market which has been quite tough this year. And to answer your question, we actually allocate tactically, rebalancing the fund on a monthly basis. We rebalance to, of course, avoid having excessive weight on within the portfolio, but we also allocate tactically depending on the market environment. We're not trading. We just want to reflect the market environment into our asset allocation, and most probably the next move will be when we start entering the next cycle, which is going to be a bull market. Most probably we will reduce the fixed income strategy and we will increase higher beta sectors.
That was going to be my next question. When the market changes, how will you match that? What will you do differently if the market goes from bear to bull? So you mentioned about the bull to bear scenario and increasing allocation to certain strategies. I think fixed income is obvious, I'm guessing market neutral strategies and trading, etc. So when then the market turns bull, that's what's going to be my next question. Where do you see a reduction in which area and an increase where? So you already answered a reduction in sort of the fixed income kind of returns, and where would you say that? Sorry, you might have said, but I didn't catch. Where would that go if you're reducing from, let's say, cash and fixed income? As you enter a bull market, where would that capital go?
So yeah, just to clarify, we don't have a crystal ball here. We are not going to try to time the market. It's not the point. The point is to offer a full participation to the whole asset class. Having said that, there are some clear indicators which show that you're in a bear market or in a bull market. And for us, it's a long-term trend. So if we see the long-term trend turning up, we don't have the bottom, but we will adjust the current allocation, being more offensive in funds where we can generate even more performance. And actually, this is what we did. 2 years ago, and allowed us to do to achieve a performance to largely outperform Bitcoin and all other competitors. So for now, we have kept the portfolio's risk profile in line in general terms with the market, but we want to keep our potential for a participation when there is a new bull market. So we're not going to be a quant fund. We're not going to be reducing the risk profile to minimize the drawdown to the minimum. So those strategies make sense, but our main focus is to provide participation on the whole asset class, full participation, diversification. We avoid the single manager risk. Keep in mind that this year with Celsius, Terra Luna, those were really stress test events, and we passed through this test. It was a success, and it showed that diversification was in place and worked. Of course, the market drew down. We had a drawdown, but this is due to the market, and there was no permanent loss of capital. So yes, you want to avoid all the complexity. You want to avoid operational risk, the risk of losing your assets. I mean, this is a very huge risk when it comes to investing in digital assets, losing your assets, being hacked, and all this. So in a complex world, we offer diversification, we offer access, yes, on a mandate which is quite simple.
Okay, then I'll zoom out. Instead of looking at, let's say, weighting, I just asked you a question about the weighting you take in your approach to the fund and the weighting of the sectors within the fund. Let's take a step back and look from an investor perspective. So we hear the term balanced portfolio all of the time when you talk about investments. So do you think that an allocation to digital assets is required, or is it necessary to create a balanced portfolio? And if so, what percentage? I guess it's different per person, but what do you see as a percentage that a balanced portfolio would allocate to digital assets?
First of all, it's up to each financial advisor, asset manager to define his own risk profile. Having said that, we actually we're always curious to understand if what we think is right, and if hard data actually confirm or not what we think. So we actually took a diversified strategy, and as a proxy, we took the blockchain strategies fund, and we said, okay, let's add a 5% allocation to this diversified strategy represented by the blockchain strategies fund. And we found out that since December 2017, even though we're in probably not so far from the bottom of the bear market, we'll see, but in maybe not the best moment to show performance figures, we can see that, and this is the, if you look at the table on the right side, the excess return that was produced, adding a 5% allocation to BSF, was close to 1% annualized. And of course, the volatility increased too, and then increased from 11.2 to 11.9 compared to the 60-40 traditional allocation. But all this to say that adding a small percentage, depending on your risk profile, to digital assets can increase your performance profile for a reasonable pickup in volatility and risk. I think we're not far from the end of this presentation, so it was good to have a recap and try to remember what we actually found out today. I mean, personally, I think that the key takeaway for me is that we've heard a lot that, I mean, crypto, digital assets were a good hedge against the equity risk, and this is just not true. On the other hand, it still makes sense to add digital assets to you in a portfolio context, but focusing on diversifying within your alternative investments. So this is a very important key takeaway for me. And of course, complex and still young emerging asset class, it's really crucial to be diversified and to do so having a multi-sector, multi-strategy approach.
Excellent. I see there's a couple of questions here, Yanis. So before we kind of close off, what have we done? 35 minutes. I'll just run through a couple of questions that we've got here, if that's okay, Yanis. So the first one, basically, let's have a look. When we speak about correlation, we should have at least 5 years historical data. Now the class is quite new and still maturing with up and down adaptation. My question is, does it make sense to talk of correlation, or do we want to use a statistical instrument that would make more sense for a younger asset class? So how valid is it really to be talking about
Yeah, I
when
understand
you've
the
got
point.
such that young asset class and obviously the volatility that exists there.
Yeah, I understand the point. On the other hand, we still need to rely on statistics and try to understand what are the underlying shifts in the market. And interestingly enough, we found out that in the past, you could hedge your equity risk versus Bitcoin, and this is not true anymore. So it's important to understand that past relationships might not prevail anymore. But you're right, we don't have the same. We cannot rely on the same historical data as, for example, U.S. equities. But I think this exercise allows us to understand better what are the market dynamics.
I guess we can only use the tools that are given. There might be question marks over the validity, but we can only use what's given, and those statistics are needed and need to be measured. You know,
it will never be a black and white approach answer. Sorry, okay. But we can still rely at least on facts as opposed to maybe headlines which are not statistically proven.
Okay, we've got two more questions. I'm going to jump to the third one first before we address a very interesting one. So we've got a question here from Tony, which states, what are your views on fundamental, so more long-term trading funds? Now, I know we have fundamental long-term trading funds within our portfolio. Just your views on that. Where do we currently sit with regards to view on long-term fundamental trading?
Yes, this is a very important core strategy for us. It's a core strategy where you can you have a high discrepancy in terms of returns from the fund managers operating in this space. So the potential for alpha generation is high, and if you pick the right funds, you can make a huge difference and outperform greatly. So we are still in a nascent emerging class. So if it's actually the place for those types of strategies, it's very difficult to outperform fundamentally on US equities. I mean, everything is you don't have it's fully arbitrage. But typically for those fund managers with a long-term fundamental approach, they can really make a difference and generate alpha. And there are huge differences in terms of performance between the fund managers for this reason. So we're quite confident that providing that we can select, I mean, the right fund managers, the best in class, then we're going to succeed in the long run.
Yeah, couldn't agree more. I mean, something from my own perspective, just to add on that, if I may, is that with this asset class, you know, fundamental trading, if you have the right fund, the right team, with the right level of research, there is this asset class can be so event driven. And a lot of those events are public knowledge. You know, if you know where to look, or if you have the contacts and you dive deep enough, you will know in advance about mainnet launches, about listings on exchanges, about hard forks. It might be the case of certain digital assets going through a fork or hard forking. So these events can give rise to a major impact on certain assets. So we talked recently about Ethereum 2.0, you know, and the merge that occurred there. If you go back many years ago, you've got Bitcoin and Bitcoin Cash, the hard fork. So there are often events and occasions that will potentially drive a digital asset up, maybe then sell off. And a lot of these are clearly defined. We know what dates these events are happening, and those who have the research and those that you know have these timelines can often play them, you know, and make money on them. Oh. And also finding an undervalued digital asset, you know, that's what the best fundamental trading funds will do. They'll give you their research. They'll know exactly why an asset they feel is undervalued, what events are forthcoming that will drive that forward, and therefore take that position until that event. So yeah, I certainly believe in long-term fundamental trading, and I do also believe that we have one of the best in class allocated to within our segment in there as well. I'm just going to jump on, I think, one more question we have here, which is an interesting one, Yanis, and I'm not sure how you'll tackle this one because it hasn't come up, but I'm going to ask it anyway. So does Blockchain Strategies Fund currently hold or intend to hold any allocation to digitized commercial or residential real estate And if so, in which geographical jurisdiction? So I think leaving the jurisdictions to one side, the thought of digitized real estate or tokenized real estate. So Yanis, it's a difficult one because I know it's not come up at board level, but I'm asking as a CIO, what's your view on tokenized or digitized real estate? Is it an asset class? Is it part of the segment that you foresee the fund being able to invest in the future?
This would probably be a vertical where some of our PEVC funds would invest. But we wouldn't add this vertical in our long-term asset allocation. We wouldn't, first of all, we don't invest directly. And second of all, it's an interesting niche and probably a potential for growth, but most probably those would be private projects where maybe some of our funds would invest as a PE investment or early stage in a token. But to my knowledge, and until recently, we have not invested in this type of sector.
I guess it comes full circle back to the answer about investing in private equity and venture capital funds, in that they have the best research teams, the deepest pockets, and are able to invest in these new verticals before they're kind of known to the public, and we're relying on those funds, if they see an opportunity, to have invested in those segments that are emerging. And I'm pretty sure, and so I like the question, that is a segment that is emerging, and I'm pretty sure that, or I'd be surprised, maybe better than I'm pretty sure, I'd be surprised if some of those VC funds are not taking positions in tokenized real estate. So I think it is an evolution of the asset class, and I think it's something we're going to hear a lot more of in the coming years. Yeah, as I said, I'd be surprised if the VC funds are not taking positions in that. So yeah, good question. Yeah, I guess that just leaves me to say, Yanis, thank you very much for sharing your views in such an illustrative way. I'm sure those listening have varying degrees of digital assets investing and experience. Some of you may be yet to make your first investment. Others are probably highly versed in crypto and maybe are holding direct stocks yourselves, direct crypto assets, or investing in various crypto funds, or possibly even blockchain strategies fund. Whatever your level of investment in digital assets, the team here at Block Asset Management are always available to help, to bounce questions off, and to speak to us about our philosophy and what we do. Of course, we are big advocates of due diligence and diversification. So whatever you do in digital assets, do your due diligence. And if you're going to enter the space, we believe a diversified route makes the most sense, as Yanis has gone through here today, hence why we offer a fund of funds in the space to provide that due diligence and diversification. If you'd like to reach out to us, you can contact us at info@blockassetmanagement.com or visit our website, blockassetmanagement.com. That just leaves me to say, Yanis, thank you. For all our attendees, thank you very much. And we'll be in communication soon about our next webinar and next update. So thank you very much for your time, and we'll be in touch soon. Ciao.